Hi, we are going to start off with a topic in finance which relates to decision making, and this has context with the time value of money chapter that we've just gone through. We are going to be looking at long term decision making and a few techniques that help in taking decisions. So, in finance terms, this chapter is known as the chapter of capital budgeting, and we'll be going through a few techniques of capital budgeting. Now, usually this is taught in the context of a lot of manufacturing caselets where you manufacture finished goods and sell them, so on and so forth. However, I'm making an attempt of teaching this in a pure marketing context so that you are able to relate to this better. So, let me read out the case for you once and then let's take it ahead in terms of the decision making aspects. Well, let me try and enlarge this. Hopefully, this is visible to you as well. Should be better. So, this case says that an FMCG company hired a content marketing agency to design a campaign for them in the year 2023. The agency specified a detailed rollout of activities in 2023 and enlisted the impact over the next 4 years, that is 2024 to 2027. The content would be generated and uploaded every fortnight during 2023, and the initial cost quoted by the agency included creatives, designing, publishing and the promotion cost. The initial cost would have to be paid by the company every quarter during 2023. However, the timing of the cash flows for 2023 may be ignored and be considered as a one-time payment at the end of 2023 for ease of calculation. So, the entire content marketing campaign will go on for 2023 and you will be paying something every month, every fortnight. However, from the viewpoint of time value of money, it does not matter if you are paying money every fortnight, this fortnight on the next one. So, for ease of calculation, I am asking you all to assume that let us say all of this money is paid to the agency at one go, which is at the end of 2023, which is year 0, the current year. Let us go on and read this further. The annual amount budgeted to 50,000 rupees, right. So, 50,000 is the cost of the content marketing campaign that is going to be run. The content creation would focus on high performing keywords, which according to the agency would propel the company onto a third position in Google rankings within a year. Approximately, the high performing keywords, 34 words it says, would have a volume of 1500 a month and a click through rate, a CTR of 11%. This would result into 5610 monthly visitors, which is essentially 34 words multiplied by 1500 searches per month multiplied by the CTR. Now, the thing to understand is that all of these are assumptions, these are estimates. The actual CTRs and the actual searches per month could be a bit more or a bit less. But in decision making, we always grapple with uncertainty, right? And we've got to get used to uncertainty and not say that, since it is uncertain, there is no point, getting into any calculations. We will get into calculations assuming that there are certain assumptions that will be fulfilled over a period of time, and then if those assumptions are not fulfilled, our decision could go wrong, right. But at least we know the reasons why the decision failed then. Let us read this further. The benchmark industry traffic to lead conversion rate is 10% and the benchmark lead to sales conversion rate is 15%, right. So, again these are assumed values, as the language is clear, these are benchmark industry rates, and this might apply, this might not apply to the case in point. However, this is a good starting point for us. If you read further, it says the actual CTRs achieved by the agency were 3%, 5%, 7%, 4% and 3.5% respectively in year 1 to 5. So, if you compare the actuals with the projected, which was 11%, the actuals are far lower than the projected rates, which is okay. which just goes on to say that in the campaign the actual rates deviate from those which were projected. The average sales value per closed sales is projected to be 50 rupees throughout the 5-year period. Now, this is again a simplistic assumption that your SKU will be sold at 50 rupees. It could be more than that as you move ahead, but let's hold prices as constant right now. The company seeks your help as a marketing graduate in taking a decision vis-a-vis the content marketing campaign. Assume that the expected rate of return on such campaigns is 20%. So, that is an assumption over here that such campaign should result into an ROI or a return of 20%. So, we will use that as the hurdle rate when it comes to making calculations. All right. Now, we have been talking about cash flows in finance since a while, and we have said that decision making needs to be based on cash flows. Now, one cash flow is very clear in this case, which is the cash outflow that we are spending 50,000 right now in year 0, which is 2023 for the content marketing campaign. However, what is not clear is the cash inflow which is likely to incur over a period of 5 years. So, we have got to go ahead and first of all understand that how do we calculate cash flows for this campaign. So, here is a small working note for the cash flow calculation, right. Let us get clear with the timeline. We are saying that we are looking at 5-year period from 2024 to 2028. During this 5-year period, the assumed or the actual CTR that the company has achieved, the agency has achieved is 3, 5, 7, 4 and 3.5%. So, that is data given to us, right. Based on this, the monthly visitors could be 1530. So, how did I get this? And let me zoom in, I hope this is clear. 34 keywords multiplied by 1500 searches multiplied by a click through rate of 3% ensures that monthly visitors in year 1 are likely to be 1530, and if I do the same calculation for the remaining 4 years, that comes to 2250, which is 34 into 1500 into a CTR of 5%, 7%, 4% and 3.5%, right. So, this leads to the monthly visitors for us. We need to move on from visitors to a lead conversion, and they have given you in the case a traffic to lead conversion ratio of 10%. So, a simple multiplication of your traffic, that is the visitors, multiplied by 10% results into monthly leads as follows, which is 153 leads per month in year 1, year 2, year 3 and year 4. Very clearly you can see that year 3 is when your data starts peaking, all right, because you have the maximum CTR of 7%. That is the closest that you get to 11%, all right. We convert the leads now into sales with the help of the lead to sales ratio, which was given to us in the case at 15%. So, if we multiply this by 15%, right, we get the monthly sales, closed sales as 23 sales, 38, 54, 31 and 21 sales transactions. We then move on to the yearly sales, which is a simple multiplication multiplied by 12 for the monthly sales. So, 23 multiplied by 12 gives you 275 closed sales transactions in year 1, year 2, year 3, year 4 and year 5. Now, this multiplied by our average selling price, which was given to you in the case as 50 rupees, will give you the yearly sales. So, 275 multiplied by INR 50 gives you a sales of 13770 for year 1, year 2, year 3 and year 4, so on. So, this is a working note is important because what it does is it helps you to zero down on your cash flow, all right. So, this is the cash inflow that I am able to achieve as a result of the content marketing strategy, which involved an investment of 50,000 rupees. This 50,000 results into a cash inflow, if I add all of this, of about 1,03,000 over a period of 5 years. But if you've gone through time value of money, you know that this 1,03,000, let me add it up so that it is clear to you, summation of these 5 years results into 103,275. So, you are earning 1 lakh over a period of 5 years as a result of investing 50,000 right now. However, if you have gone through time value of money, you know that all of these are future values, and these future values cannot be compared with the present value, which is a 50,000 investment right now. Hence, we have got to convert this future into present in order to make a meaningful comparison, all right. That is where the first technique comes in. So, let me type that out as NPV, net present value method, all right. NPV as a method involves calculating your cash flows for a 5-year period. We just looked at the cash inflows for 5 years. These are just cells which are linked from the earlier working note. So, I have only dragged these cells from the earlier working note. So, these sales calculations result into your cash inflow over here, all right. Now, as I said, these cash inflows in time value of money terms is known as future value, right. What I have got to do is I have got to convert this into a present value using a PVIF of 20%. Why am I using a PVIF of 20%? Because you were given a hurdle rate of 20% by laying down expectation. So, expectation of return from such a deal is 20%. So, 1 divided by 1.2, that is 1 divided by 1 plus R raised to 1, that is the PV factor for year 1 and then for year 2, 3, 4 and 5. If I multiply the cash flow with the PVIF, what I get is the present value of cash inflows, right. So, let me copy paste this as a formula and I get present values as under, right. And if I sum it up, what do I get is a total cash inflow of 61,000, and I will term this as present value of cash inflows, right. That is the cash flow that I am able to earn in present value terms. Now, this entire deal results into a cash inflow of 61,317 and our initial investment was 50,000. So, I will term that as present value of cash outflows, which is minus 50,000. The reason I am writing minus 50,000 is because I want to be clear that 50,000 was a cash outflow and 61,000 is a cash inflow, which gives me the net present value. So, the NPV or the net present value is present value of cash inflows minus present value of cash outflows. That is how the formula looks like, all right. So, over here I am not saying minus, I am just adding 50,000 to it because I have already shown that as a negative 50,000 showing an outflow. So, this plus this results into a positive 11,317, which is in PV terms, everything as in year 0, which is 2023 terms, right. So, what this goes on to tell me in terms of a technique is that if I were to invest 50,000 in this content marketing strategy right now, then this 50,000 results into a net cash inflow of 11,317, and this 11,317 is calculated at a rate of 20%, right? That means it fulfills my return expectation. If my NPV is positive at an expected rate of return of 20%, that means this project is doing good in terms of earning more than my expectation. So, if at 20% your NPV is positive, it means that this project is earning more than 20%. Two, just to be a devil's advocate over here, if I change this rate from 20%, let's say, to 40%, all right, and now if I look at my NPV goes negative to 8980. What does this indicate? One very simple concept of time value of money, which is if the rate of interest goes up from 20 to 40%, your present value goes down. So, from 63,000 odd, the present value falls to 41,000, resulting into a negative NPV. That's the basic of time value of money, a negative relationship between the rate of interest and present value calculation. However, more importantly from a decision making point of view, it means that this project does not earn 40%. It earns less than 40% because at 40% your NPV is negative. Remember and recall that at 20% this NPV was positive. In other words, this project is earning a return which is more than 20 but less than 40. Very clearly, the return on the project lies between 20 and 40. However, a lot of people are okay not finding out the rate of return and are okay looking at what 20% and a rupee value, an absolute value which is an NPV value running into a few thousand rupees. So, if I undo these changes now, right, I come back to my original calculation, which is an NPV of 11,317, and I am saying as a manager I am good looking at 11,317 an absolute value in rupee terms, and I am comfortable taking this decision. The only tricky thing is, when I am comparing this project, a content marketing strategy, with something else, let us say a traditional marketing campaign, which does not involve a 50,000 cash outflow, but it involves a cash outflow of let us say 75,000. Then on 75,000 your NPV could be a bit different, let us say it is 12,500. Now that is where you get stuck, that on an investment of 75,000 you got an NPV which is positive of 12,500, and on an investment of 50,000 you got an NPV which was positive 11,317. Both NPVs are positive, and your decision making rule says if the NPV is positive, accept the project, but we can't accept both the projects because we have only limited money. I do not have 75 and 50 both to invest. So, I will have to choose between two projects which are not of the same size, one which involves an investment of 50,000, the other which involves an investment of 75,000. I can't compare these two NPVs, right. So, the issue with NPV calculation is that when you compare projects with an unequal size, where the investment amount is different, then looking at an absolute amount and making a comparison becomes difficult. Another issue with NPV is when you compare NPV of projects with different time periods. Like this is a 5-year project. If I compare the NPV of a 5-year project with the NPV of let us say a 15-year project, is it even comparable? Probably not, right. And hence, because of certain limitations of NPV and also because of a basic human tendency of wanting to think in terms of relative amounts, percentages, and not absolute amounts which is rupees in thousands or lakhs, I want or I feel the need to move from a rupee based decision making criteria to a percentage based decision making criteria. What do I mean by that is the term internal rate of return. Now, this can become confusing, the word IRR, internal rate of return. You could probably interpret this as a simple word, rate of return. And I already discussed this, that at 20%, if your NPV is positive, that means this project is earning more than 20%. And you know, just a while ago, we converted this 20 to 40 and this NPV became negative. And we concluded that this project earns less than 40, right? Now, I want to close down this gap. 20 and 40 is too big a gap. So, what do I want to do is, I want to bring it down closer and then say that it earns more than 20 but less than XYZ, and then try and catch through a trial and error method the internal rate of return of this project, which is the IRR of the project. Now, mind you, I have already introduced you to the trial and error approach in time value of money. So, this approach is not going to be any different. All that I am doing is showing this to you on Excel so that you could try it out yourself. So, let me add a column over here. Let me say I am using a PVIF at the rate 30%. We tried out 40, I want to now look at 30 and see if at 30 also we get a negative NPV. So, that is my annuity PVIF, and if I copy paste that and then I multiply the cash flow 13,000 into the PVIF at 30%, that gives me the present value. We repeat the process and see what is the value. The value comes to 49,000, and 49,000 as an inflow vis-a-vis an outflow of 50,000 indicates an NPV which is a negative NPV of 448 rupees. So, I have been able to close down the gap. I am saying this project earns more than 20 and less than 30. This is still a 10% gap in my trial and error approach. So, if I want to be really very accurate, I do not want to say that this earns more than 20 and less than 30. Maybe I want to close this down and say it earns more than 27 and less than 30. Then I will be able to get a very accurate IRR. So, let me do one more calculation over here, try my luck at 27%. I do not know whether this turns out to be positive or negative, but 1 divided by 1.27 raised to 1, that is the PVIF at 27%. That is the trial and error approach for you, right. And if I again convert this into present value at a PVIF of 27%, how do my cash flows look, right. Let me total it up, that comes to 52,000. So, my NPV is positive by 2,677. So, this now looks good to me, that at 30% my NPV was negative 448 and at 27% my NPV is positive 2677. So, this project earns a wee bit more than 27 and a wee bit less than 30. What is the IRR calculation? So, let me give this a title over here, that this is my IRR calculation by the trial and error method, all right. And as usual, we put down a simple equation, rate is to the present value. So, at a rate of 30%, let me not say present value, let me say present value only. At a rate of 30%, my present value was 49,000. At a rate of 27%, my present value is 52,000. So, 30 minus 27, for a delta of 3%, what is the change in the present value? 3125. So, when my rate goes up from, when my rate changes from 27 to 30 by 3%, my NPV changes by 3125. Now, the value that I wanted was accurately 50,000, right. Let me type that out properly. So, if I want a value of 50,000 and if I am at 49,000, then the change that I am looking at is 50 minus 49. I want a change of 448 in my present value in order to ensure that my present value is exactly equal to the targeted value of 50,000, right. So, let me do a cross multiplication. 448 into 3 divided by 3125. So, that gives me a percentage value which is 0.43%. So, if I want to change my present value from 49 to 50, that means if I want to change it by 448 rupees, so that my inflow is exactly equal to 50,000, which is the targeted value because that is my outflow as well. If I want my inflow to change by 448, then my rate has to change by 0.43%, 0.43% from 30%, all right. So, do I add 0.43 to 30% or do I deduct 0.43 from 30%? It is very clear, since my answer lies between 27 and 30%, I will have to deduct 0.43 from 30%. So, the IRR is going to be equal to 30% minus 0.43%, which is essentially 29.57%. So, this project let me repeat this, I told you that this project earns less than 30 and more than 27. At 30% the NPV was negative, that means it earns less than 30. At 27% the NPV was positive and that means it earns more than 27%. The question is, how much does it exactly earn? What is the rate of return slash IRR of this project? That comes to 29.57%. Now, the last bit of it, if you notice, I have reduced the decimal points over here. Actually, this is 29.5698%. I can round it off to 570%. And if I do this calculation one more time, or for want of space, let me do it over here, so that the entire screen is visible to you all. Let us say I use a PVIF at 29.570%, all right. So, 1 divided by 1.297, all right, raised to, let me give a cell reference of this, raised to 1, all right. All right, and copy paste this for the remaining years. So, this is how the formula looks like, just for your reference, all right, raised to 1, and this would be raised to 5 for year 5, all right. Now, as usual, I am using this present value PVIF to convert this into present value of cash inflow. So, PVIF multiplied by the cash flow of year 1, 13770, right. And if I copy paste that, what do I get as a summation is 49851. Now, technically this should come to exactly 50,000. The reason it does not come to exact 50,000 is, I told you, this has been rounded off to 29.570. If I increase these decimals, it is 29.56978. Let me try that. 29.56978%, right. Let us do that as well, 29.56978, right. And if I change my PVIF, you see this getting closer to 50,000. So, if I use this as follows, 1 divided by 1 plus, let me give you the reference rate as the IRR rate and then say raise to come to 0. However, that is a rounding off error, that is not an issue. Let us revisit this and close this as a concept. When I use IRR as the PVIF, alright, you realize that my present value of inflows are exactly equal to the present value of outflows and my NPV becomes 0. Now, this is where it becomes a little bit confusing for a lot of students, because an NPV of 0, a lot of people tend to think about this in break-even terms. Now, you are taught break-even point in cost and management accounting, and please remember, in CMA you do not do any present value calculations. Do not confuse IRR with break-even. All textbooks in finance will give you this one liner that at the IRR the NPV is 0, but that does not mean that the project results into a no profit no loss, and a 0 NPV does not mean a 0 profit loss. So, let us get that out of our way, point number 1. Point number 2, let us realize that this project earns a return of 29.56% when your expectation of return was 20%. So, the rule for decision making of IRR is simple. If, I will write it down over here for you, if the IRR is greater than your expected rate of return, or let us say your cost, then it is an accept decision. However, if the IRR is less than the expected rate of return or the cost, then it is a reject decision. What do I mean by this? I am saying that compare your cost of capital with your expectation of return. If your expectation of return is met with by the IRR, so if your IRR is 29% and you were expecting 20%, you should be happy with it, go ahead and accept the project. However, if your expectation of return from this project was 35%, then 29% is not good, you should reject this project. What determines your expectation? That is a very important point. One thing that could determine your expectation is the cost, and when I say cost, I do not mean raw material cost and salary cost and electricity cost, I mean cost of capital. What do I mean by capital? You invested a capital of 50,000 in this project. Where did you get this money from? Did you borrow it from a bank? Then you will be paying some rate of interest on the loan, which is your cost. Did you raise this money from shareholders? Then it is the cost of raising capital, known as cost of equity. Or did you get this 50,000 from accumulated returns on your business earlier on? Then it is the cost of retained earnings. If this 50,000 was simply lying with you in your savings, then it has an opportunity cost. So, when I write the word cost, it has different connotations, and we will talk about this in detail as we move on, specifically when we deal with the chapter of cost of capital. But I will come back to this. What determines your expectation of return? Usually the cost at which you source your money from will determine your expectation of return. Compare that expected rate of return with the actual rate of return. What is the actual rate of return? The IRR. If your IRR is more than your expected rate of return, be happy, smile, go ahead and accept the project. This is a method works for all those people who are wired to think in terms of percentages. Those people who are not wired in terms of percentages and are okay looking at values which are absolute values would be happy with an NPV calculation. Usually NPV and IRR give you the same decision. So, if NPV is positive and it says accept the project, then IRR will also say accept the project, because your IRR will also be more than the cost. I will tell you why. What did you use as a discount factor over here? 20%. which is your expected rate of return. And if at the expected rate of return your NPV is positive, that means your IRR is more than your expected rate of return, which is 20%. So a lot of people don't calculate the IRR. They say I'm okay with it because since the NPV is positive at 20, your IRR is more than 20. However, is it 21 or 22? Or like in this case, is it 29? It matters, and hence people go ahead and calculate the IRR. Coming back to the earlier point, usually NPV and IRR do not give a contradictory decision. NPV and IRR usually give a similar decision. If NPV says accept, IRR will also say accept. There are a few exceptions to this rule, and as we move on in the chapter ahead, we will talk about these exceptions. But I hope the concept of NPV as a technique for decision making and IRR, internal rate of return, or in very plain language known as rate of return, both these decision making tools and techniques are clear for you, that how do you go ahead and take decision based on this. Thank you.